Stocks have surged higher to all-time highs amidst the US-Iran war and some of the frothiest valuations in history. And companies like Allbirds, Amidst, are jumping hundreds of percent in a single day just on the backdrop of AI. There's so much to consider with the deja vu of bubble behavior, record deficits, falling rates, the war, and AI arguably the most unprecedented technological revolution in history. How can we possibly put all of the pieces together into a simplified framework on where to invest our money? Well, in this video, I'm going to give my take on how to do just that and how I'm positioning my $500,000 portfolio. And unlike others sharing a dummy model portfolio or vague positioning, my portfolio represents 99% of my net worth and I share my exact positions and sizing. Now, before I get into the framework of making sense of everything going on, last month I was pounding the table on BHP. This company is the largest copper miner in the world and positioned for continued production growth into the 2030s as copper deficits widen. I released my overview video on March 16th, 4 days before the recent low, and it's up 20% since then. If you want to check out that video, I'll link it on the screen here. Now, I don't suspect this company to take off without a continued or even deeper correction than the recent low, but I do see this as a 10+ year hold, and I'd love to accumulate a lot more if given the opportunity. All right, now let's get into how to make sense of everything going on. Well, I want to start with this post from Robert Breedlove. It says, individual psychology is irreducibly complex, and collective psychology is infinitely more complex. It is therefore laughable that market economies can be modeled, predicted, or managed in any way whatsoever. I think this is largely true, and when you add in the holistic complexities of markets, including credit, rates, money supply, macroeconomics, geopolitics, and everything else under the sun, it would seem delusional that one could make any reasonable prediction. There are a lot of people out there deeply knowledgeable about these intricacies who are seemingly quite successful, such as Luke Grahman and Lynn Alden. But the reality is that these people both have a deep passion and interest in these topics and have made it their life's work. What about an average person like me who loves the game of investing and trading, but also has a day job and maybe family, and so can't or won't spend significant time and energy learning about all these deep elements? Or dare I say, honestly, isn't interested since it can seem so futile, or not being intelligent enough to wrap my brain around it all? Well, in my humble, honest opinion, I don't think you need to study any of that to be successful. I think you can spend a fraction of the time on research and studies to achieve 80% of the outperformance. And my aim is to be an example of that. So let me tell you how. But before I do, I have to say it's completely fine to be somebody who dollar cost averages into index funds with Vanguard, like VOO, and just calls it a day. In the long term, you'll maintain market performance and do very well, assuming you continuously average in over time and you have enough time to outlast sequence risk. But I think you're watching this video because you're passionate about investing like I am and enjoy the prospect of outperformance and the challenge to achieve that. So starting off with the first point, instead of deeply learning the intricacies, focus on key long-term trends, valuations, and sentiment. Basically the bigger picture. Psychology may be unpredictable in the short term, but becomes more and more predictable the more you extend your horizon. Think of the ocean tide. You can't predict how every wave will crash on the beach, but we can predict the tide moving in and out over longer periods of time. Markets are just like that, especially certain asset classes like commodities. But bringing it back to the stock market, all you need to know right now is that valuations are stretched. It's nothing you haven't heard before. But why focus time and energy there when there are other asset classes and specific sectors that are much more attractive, especially on a relative basis? Can the stock market move up another 50% from here? Of course it can. The market can do anything. But history tells us it's not a good bet. This bull run has been significant, with the Dow up almost 1,000% in 17 years. And the CAPE ratio is also at historic highs. This is why almost 50% of my portfolio is exposed to precious metals. On a relative basis, gold and really commodities in general are on the cusp of a significant breakout versus the stock market. Ratio charts like this, which is gold over the S&P 500, are an amazing tool to see relative value. You can see how it's been basing for the last 10 to 12 years, and we just broke out recently. And regardless of if this is a back test or it's going to come back in and chop around for a bit before continuing up, this does significantly look like a change in trend. And when I plot that same ratio of gold against the NASDAQ instead, you can see it looks even more appealing. This is an example of how you can see long-term trends. It's a great indicator of relative value, and when you maintain this simplicity on these long-term trends, you free your mind and energy to focus on finding value and opportunities in these other themes like precious metals and commodities. Which leads into my second point, leveraging outsourced research. There are so many people who make market research their life's work. You can find quality research on any asset class, sector, or niche. You don't have to reinvent the wheel. Build your team of trusted people, test the quality of their information and insights over time to refine the list, and utilize their knowledge to learn and construct investment themes and ideas. I have a lot of people on my team, but a core few I mainly focus on, and ultimately I synthesize the collective into ideas and utilize my own knowledge in tandem to build out my portfolio. If you want to see who's on my team, you can see who I follow on X. Some great precious metals and commodities follows are people like Jordan Royburn, Don Durrett, Rick Rule, and Tavi Costa. And as a bonus, if you're interested in cycles, Palobar is a great follow, and I would consider him the number one person that I follow on X. And the last point, which I've said before, is to always stay learning and align your positioning to your knowledge and conviction. You can't follow ideas or people's actions blindly. Otherwise, you won't have the staying power to maintain your stance during inevitable volatility. So while I see a lot of people wrapped up in AI pumps or cryptos crashing to zero or trying to decipher the war or Fed policy or what's coming next, I'm quietly positioning myself to be ahead of any further or continued market weakness and also layering deeper into the commodities arena that I so strongly believe in. And that leads me into my latest portfolio updates. I closed some of my position in Dakota Gold since I was overweight what I wanted to have. I also closed Vermilion Energy as I had always planned for that particular position to be a shorter term swing trade. I also closed a number of other positions to clean up my holdings and raise more cash. That includes the Chinese stocks, JD, KWeb, and Baba. It includes some farmland REITs, land, and FPI. I closed Black Iron because I'd rather have the cash right now than see if the trade works out. Plus, there's risk in Ukraine with that stock. And then I also closed Hercules Silver because I don't know the timeline that that's going to play out on, and I'd rather have the cash. I also moved the cash I had in American Waterworks into Essential Utilities. Those stocks are merging anyway. I also trimmed 10% of my Cisco Metals position because it's been outperforming, and I want to trim into strength, which is the plan I've been talking about all along. And then I also tried a short on the S&P 500 right here when it started stalling. But when it gapped down on Sunday and then just rallied right back up and past where I entered, I closed it since there was a lot of risk the market would keep going, and it's looking like it's a good thing that I did close it. Now, something I've been thinking about is adding to my oil and gas stocks here. There's been a decent pullback in some names like Exxon, Chevron, and Tourmaline. And I do think we'll see a continuation in the war and global disruption. What would you do? Are you buying oil and gas stocks here? Let me know in the comments below. That's all for this video. Thanks so much for watching. I'll see you in the next one.